As of the first quarter of 2026, Americans owe $1.25 trillion in credit card debt, according to the Federal Reserve Bank of New York. But the more dangerous number sits underneath that one. 44% of cardholders don't even know the interest rate on their own card. If you carry a credit card, at least one belief in this video is something you've probably accepted as fact. Heard from a parent, a friend, or a video online. This video breaks down the credit card myths the data proves are not just wrong, but expensive. Using research from the Federal Reserve, FICO, LendingTree, and the Consumer Financial Protection Bureau. One of these myths is believed by 72% of Americans. It does nothing for your credit score. It just quietly costs you interest every single month. Stick around to the end for the one habit the highest scoring consumers actually use. The problem. The real issue isn't that credit cards are dangerous by design, it's a literacy gap. 44% of all cardholders don't know their own interest rate, officially called the APR. That climbs to 57% of baby boomers and 49% of Gen X, against 35% of millennials and 33% of Gen Z. 51% of women don't know it, compared to 38% of men. Why it happens? Part of this comes from how people use their cards. 72% of cardholders have used one to cover an emergency expense. 81% among parents of young kids. 26% of all cardholders, including 43% of Gen Z, believe they don't even need an emergency fund because a credit card can cover it. That belief turns a short-term tool into long-term debt. Myth 1. Carrying a small balance improves your credit score. A 2026 FICO survey found 72% of people believe this or aren't sure it's false. LendingTree puts the number who believe it outright at 59%, highest among lower-income cardholders, the group least able to absorb the interest. The reality: carrying a balance does nothing for your score. It only generates interest. Your credit score is built from 5 weighted factors: payment history, 35%, amounts owed, 30%, length of credit history, 15%, credit mix and new credit, 10% each. Amounts owed is measured by utilization, your balance divided by your limit. The highest scores keep that under 10%, which means paying in full, not carrying debt. A related myth: 67% think their income affects their score. It never does. Bureaus don't record your salary. Myth 2. The 15/3 payment hack boosts your score. Social media claims that paying half your balance 15 days before the due date and the rest 3 days before forces 2 positive reports a month and lowers utilization. Both claims are false. Issuers report to the bureaus once a month and only as current or past due. 1 payment or 20 makes no difference. The balance that actually gets reported is locked in on your statement closing date, roughly 21 to 25 days before the due date. So 15 and 3-day payments happen weeks after that higher balance was already sent to the bureaus. It does help in one real way. Paying early lowers your average daily balance, cutting the interest that compounds daily on carried debt. To actually lower reported utilization, payments need to land before the statement closes, not before the due date. Myth 3. The minimum payment is a safe way to handle debt. One of the costliest beliefs in personal finance. Issuers set the minimum at 1 to 3% of your balance plus interest and fees, or a flat $25 to $40 floor, whichever is larger. That amount shrinks as your balance shrinks, so early payments go almost entirely to interest. On a $5,000 balance at 22% APR, paying only the declining minimum takes over 600 months, more than 50 years, and costs over $32,946 in interest alone. A fixed $200 payment instead clears the same debt in 34 months, for $1,750 in total interest, a difference of over $31,000 in 47 years. This isn't just a low-income problem. 40% of cardholders earning over $100,000 a year Still pay only the minimum on at least one card. Myth 4. Paying your statement in full means you owe nothing next month. Interest accrues daily, so any gap between your statement closing date and the day your payment actually posts creates residual or trailing interest, a small charge that lands on your next bill after you thought the account was clear. A $500 balance at 21% APR with a 14-day gap generates about $4 in trailing interest. Small, but enough to trigger a late fee if it's missed. To truly zero out a balance, request an official payoff amount from your issuer instead of just paying the statement total. Myth 5. Closing an old or unused card cleans up your credit. It can actually drop your score 3 ways. It erases that card's credit limit, spiking your utilization. $2,000 owed against $10,000 of total limit is 20%. Close a $5,000 limit card, and the same debt against $5,000 remaining becomes 40%. It shrinks your mix of active accounts, and a closed account in good standing stays on your report for up to 10 years. Once it drops off, it can lower your average account age. A related trap: chasing sign-up bonuses. 74% of cardholders have signed up for a card's bonus. 31% missed the spending requirement, and 31% lost their rewards entirely by canceling too soon. Each application triggers a hard inquiry, a credit check that causes a small, temporary dip, and issuers can claw back bonuses from repeat churners. Myth 6. Debit and credit cards protect you equally from fraud. Credit card fraud falls under the Fair Credit Billing Act. Because it's the bank's money at risk, not yours, your legal liability is capped at $50. And $0 if only the card number was stolen, not the physical card. Most issuers voluntarily drop that to $0 regardless. Debit card fraud falls under the Electronic Fund Transfer Act, where liability depends entirely on speed. $0 if reported before any unauthorized charge, $50 within 2 business days, $500 within 60 days, and unlimited liability if you wait longer. Because it's your real bank balance being drained, the damage, overdrafts, bounced payments, happens immediately before any dispute is resolved. Myth 7. Checking your own score or shopping around for a loan damages your credit. Checking your own report is a different kind of check entirely. A soft inquiry with zero impact, invisible to lenders. A hard inquiry, the kind that comes from applying, typically costs fewer than 5 points. For auto and mortgage loans specifically, multiple lender inquiries within a 14 to 45-day window count as a single inquiry, so comparing rates doesn't multiply the damage. That same fear pushes people toward credit repair companies charging upfront to fix a score, which is illegal under federal law. Disputing real errors yourself is free and just as effective. The fix isn't complicated. Pay your statement in full every month. To optimize further, keep every card at 0 except one, left with a small balance under 10% utilization, a method called AZEO. Ignore payment timing hacks. Pay down balances before the statement closes instead. When clearing debt, call and request your exact payoff amount. Keep old cards open. Downgrade to a no-fee version instead of closing them. And route everyday spending through credit, not debit, so fraud never touches your actual cash. None of this is about willpower, it's about knowing the mechanics your card issuer already knows. Every myth here carries a real dollar cost. Extra interest, a lower score, or a fraud loss a single phone call could have stopped. And income doesn't protect you from these mistakes. Cardholders earning 6 figures fall into the same traps as everyone else. The only real fix is closing the information gap. If this video changed how you think about your credit card, subscribe for more data-backed videos on financial literacy, smart credit habits, and the decisions that quietly shape your future.